Welcome to Iron Financial, where we forge stronger portfolios and cut through market weakness. Today, we're not just looking at a stock, we are stress testing a company's entire structure, right from the foundation all the way up. The company is Sprinklr, ticker CXM, and what we've uncovered is a fascinating, almost brutal battle between rock-solid fundamentals and just terrible market sentiment. We're going to dig into the numbers, we're going to examine the story, and I promise you, by the end of this, you'll know whether this is a skyscraper in the making or a house of cards that's about to get blown over.
Okay, let's just dive right into the heart of the matter. The central conflict here is, well, it's impossible to ignore. Sprinklr just came off an earnings report that, on the surface, looks absolutely fantastic. I mean, they beat on the top line, revenue. They beat on the bottom line, profits. And they're showing consistent, steady growth. It's really the kind of report that should have investors popping champagne corks. But they're not. In fact, it's the complete opposite. The stock has been absolutely hammered. Year to date, we're talking about shares being down nearly 28%. So what you've got is the market telling us a completely different story than the company's own financial statements. That's the kind of disconnect that really gets our attention here at Iron Financial. It just screams one of two things. Either this is a massive, overlooked opportunity, a structural bargain just waiting to be bought, or it's a cleverly disguised trap. And that's the big question we're here to answer today.
So, here's how we're going to deconstruct this entire mystery. First, we'll expose the sheer scale of the CXM disconnect. We're going to put that stock's performance under a powerful microscope. Second, we'll do what we do best here. We are going to forge the financials. We're going to pour the concrete, mix it ourselves, and see just how strong this company's earnings foundation really is. Third, we'll start assembling the bull case, looking at the steel framework, the I-beams that are supposed to support a positive outlook. Fourth, and this is crucial, we'll play devil's advocate. We're going to search for any cracks in the foundation, the risks, the red flags, the things the market is clearly so worried about. And finally, after all that, we'll deliver the Iron Financial verdict. Let's get to it.
Okay, part one, the CXM disconnect. You know, before we can even begin to analyze the blueprints of this company, we have to acknowledge the earthquake that's been shaking its stock price for months. The core issue we're investigating is this profound gap, this chasm between what appears to be fundamental corporate strength and this deeply negative, almost hostile market sentiment. It looks like a structure that is solid on paper, but the very ground it's built on feels incredibly shaky to investors. Our job is to figure out if those tremors are a warning of an imminent collapse or if they're just temporary noise. Now, let's just look at the brutal reality shown right here on this chart. That massive red bar on the left, that represents CXM's year-to-date performance, a plunge of nearly 28%. Now, compare that to the tiny little bar next to it, which represents the S&P 500 over the exact same period. It's basically flat, down less than a single percent. So CXM isn't just underperforming, it is being aggressively, purposefully sold off while the rest of the market basically holds its ground. For any shareholder who's been holding this thing since January, this has been pure, unadulterated pain. The market is pricing this company for failure, not for success. And that's the crux of it, right? This isn't just some tech stock getting caught in a broader downturn. No. This is a specific targeted sell-off. Something about Sprinklr is making investors a run for the exits, even when the broader market is just treading water.
So this right here, this is the mission for today's deep dive. The numbers are strong, the stock is weak. We're going to get to the bottom of why. We are going to run the diagnostics, we're going to check the load-bearing walls, and we're going to see if the market has spotted some fatal flaw that the earnings report is somehow hiding, or if it has just completely misjudged the strength of this company's construction. Let's move on and start pouring some concrete.
All right, let's get to the heavy lifting. Part two, forging the financials. Look, opinions, sentiment, fear, that's all just noise. At Iron Financial, we build our analysis on a foundation of hard, cold data. So before we can pass any kind of judgment on this company, we need to pour the concrete. We need to examine the numbers, piece by piece, from their latest quarterly report and see if they really are as solid as the headlines suggest. So let's start at the top, with the top line. First up, Q4 revenue. As you can see, Sprinklr reported $220.59 million. Now that beat Wall Street's consensus estimate by 1.68%. It's not a massive blowout beat, but in this kind of tough macro environment, it's a solid, clean pass on their first test. So, step one, they're bringing in more cash than the so-called experts expected. Check. But revenue is only half the story, right? What about profitability? Did any of that cash make it to the bottom line?
Exactly. And on the bottom line, they reported 13 cents per share. The consensus estimate, what Wall Street was expecting, was just 10 cents. So another clear beat. This tells you they're not just growing sales, they're translating that revenue into actual profit more efficiently than anyone predicted. And that shows real operational strength.
And let's be clear about that 13 cents per share. It represents a 30% earnings surprise. 30%. That's not just scraping by, that's a statement. It suggests Wall Street's models fundamentally underestimated this company's earnings power. Management isn't just meeting their goals, they're shattering them. Okay, look, a 30% surprise is a heavy-duty number. I'll give you that. But is this a one-time fluke, a flash in the pan? Or is there a pattern here? A single good quarter can be an anomaly. We need to see if this is a real trend. That is absolutely the right question to ask. And the answer is no. This is not a one-off. Looking at the year-over-year comparison, the story gets even stronger. In the very same quarter last year, they posted revenues of about $202.5 million and earnings of 10 cents a share. This year, revenue is up to $220.6 million and EPS is up to 13 cents. This demonstrates a clear, undeniable trajectory of growth. We're seeing a nearly 9% increase in revenue and a full 30% jump in earnings per share year over year. This, my friends, is the definition of a strengthening foundation.
And just to hammer the point home, look at this table. This isn't some recent development. Over the last 4 quarters, an entire year, Sprinklr has surpassed consensus EPS estimates 4 times. We see a 33% surprise last quarter and significant beats in the 2 before that as well. This isn't luck. This is a clear pattern of execution. It shows a management team that consistently underpromises and overdelivers. It's reliable. This is exactly the kind of concrete foundation you want to see before you even think about building a bull case on top of it. All right, okay, the foundation is solid. I'll concede that. Consistent, profitable growth, but a strong foundation is pretty useless if the framework you put on top of it is weak. So what else is there? What else justifies buying into this thing, especially with that horrifying stock chart we just looked at?
Okay, let's move on. Part 3, building the bull case. The financials are solid, all right? The concrete is poured and it's cured. But you can't build a skyscraper on a foundation alone. You need a steel frame. You need structural supports that can actually withstand market pressure. So beyond the pretty earnings report, what are the core pillars that would make someone genuinely bullish on this company? What's the real story here?
So the crucial point to understand is what Sprinklr actually does. It's not just another generic software as a service company. They've built what they call a Unified Customer Experience Management Platform, or Unified-CXM. The whole idea is to break down the silos between departments inside a big company. They provide a single platform for a massive enterprise to manage every single customer interaction, from marketing to sales to customer service to social media, creating one seamless, unified view of the customer. And in an era where customer experience is literally everything, that is a powerful, powerful value proposition. And this right here, this is arguably the strongest steel beam in the entire structure. Just look at who is buying their product. We're not talking about startups or small businesses here. We are talking about over 1,900 of the world's largest enterprises. I mean, companies like Microsoft, Procter & Gamble, Samsung. In fact, 60% of the Fortune 100 are Sprinklr customers. Now that is a heavy-duty client list. These aren't companies that make frivolous purchases. They do extensive, painstaking due diligence. So having them as clients isn't just a revenue source, it's a massive vote of confidence in the underlying technology. And it also provides a sticky, reliable, and predictable revenue base. That's a key structural support right there. Now this next piece of the bull case is absolutely critical: stock buybacks. It's really important to understand what a buyback actually is. When a company uses its own cash to buy its own shares off the open market, it's not just some boring financial maneuver. It is a direct signal from the people who know the company best, we're talking management and the board of directors, that they believe their stock is cheap. It's them saying, hey, we think the absolute best investment we can make right now is in ourselves, because we believe the market is profoundly undervaluing our future. And Sprinklr isn't just sending a signal, they are shouting it from the rooftops with a megaphone. They have just authorized a $200 million stock repurchase program. Let me put that in context for you. For a company of this size, that is a massive commitment of capital. Management is looking at their strong financials, they're looking at their blue chip client list, and they're looking at their beaten down stock price, and they are stepping in with a huge amount of their own cash to say the market has this completely wrong. This is the ultimate insider buy. It is the single most powerful pillar in the entire bull case.
All right, I have to admit, that's a compelling bull case. A solid foundation of earnings, a steel frame of blue chip clients, and a massive $200 million vote of confidence from management itself. But we have to come back to reality. A stock does not fall 28% for no reason. Despite all this apparent strength, the market is terrified of something. So now we have to do our due diligence and survey the risks. It's time to put on our hard hats and look for the cracks in the foundation.
Okay, the first potential crack comes from a widely respected rating system. The Zacks rank for Sprinklr is a number 3, which translates to a hold. Now look, a hold isn't a sell, but it's certainly not a buy. This rank is based entirely on trends in earnings estimate revisions from analysts. What a number 3 rank suggests is that based on all the latest data, analysts expect the stock to perform in line with the broader market in the near term, not outperform it. It definitely tempers some of the excitement from that big earnings beat and suggests the near-term future might just be, well, average. Now to me, this is a much bigger crack. This is a potential structural issue. Sprinklr exists within the technology services industry, and according to Zacks, that industry currently ranks in the bottom 28% of all 250-plus industries they track. Think of it this way. You can build the strongest, most beautiful house in the world, but if you build it in a bad neighborhood with crumbling infrastructure and no one wants to live there, its value is going to be dragged down no matter what. That's exactly right. This is a serious headwind. You know, a rising tide lifts all boats, but a falling tide can ground even the most seaworthy ship. Sprinklr might be a best-in-class company, but it's operating in a sector that is clearly, deeply out of favor with the market right now. Big money managers, we're talking hedge funds, pension funds, they often make allocation decisions at the sector level first. And if they're pulling money out of tech services as a whole, good companies can get thrown out with the bad.
And that brings us to the final and perhaps the most significant crack in the whole structure, the valuation. Now let's just break this down simply. On the surface, the trailing PE, the price-to-earnings ratio, of around 13 looks incredibly cheap for a tech company. That number is based on the profits the company has already earned over the past 12 months. But here's the thing. The market doesn't drive looking in the rearview mirror. It looks ahead through the windshield. The number that really matters is the forward PE, which is based on what analysts expect the company to earn over the next 12 months. And that number is a whopping 56. That is a massive, glaring discrepancy. So what does it mean? It means that while the company has been solidly profitable, Wall Street is projecting that its earnings are going to fall off a cliff in the near future, which in turn drives that forward-looking valuation way, way up. And this connects directly back to that weak industry rank we just talked about. The fear is that the bad neighborhood is going to hit Sprinklr's bottom line hard, whether it's through longer sales cycles, pricing pressure from competitors, or clients just cutting their software budgets. Exactly. So my question is, why should any investor pay such a massive premium, 56 times future earnings, for a company that analysts expect to earn less money next year, especially when its entire industry is facing these major headwinds? It feels like you're being asked to be a penthouse price for an apartment in that questionable neighborhood we just talked about. That is a tough pill to swallow, and it's likely the single biggest reason for that ugly stock chart. Okay, we've laid out the bull case and we've laid out the bear case. We've inspected the foundation and we've searched for cracks. Now it's time to put it all together. Part 5, the iron financial verdict. We are going to weigh all the evidence we've just presented, we're going to balance the strengths against the weaknesses, and deliver our final, actionable verdict. Is Sprinklr an opportunity, or is it a trap? So let's look at the tail of the tape. In the bull corner, you have the heavy hitters, a consistent, undeniable history of shattering earnings estimates. You have an A-list, blue-chip client roster that provides a stable, predictable revenue floor. And you have that massive $200 million buyback, which is literally management planting their flag and screaming that their stock is undervalued. And in the bear corner, you have some equally powerful arguments. You've got the severe, brutal stock underperformance that you simply cannot ignore. You have the weak industry rank, that bad neighborhood problem casting a long shadow over everything. And you have that sky-high forward PE ratio, a valuation that seems to be pricing in a lot of future pain, not gain. It is a true clash of opposing forces. So here it is, the iron financial verdict. After stress testing this entire structure, our conclusion is this. CXM's foundation is solid, but the neighborhood is weak. The company itself, its execution, its product, its client base, and its profitability is fundamentally sound. The financial reports prove it, period. However, the market headwinds facing the broader tech services industry are real, and that valuation based on forward estimates is frankly demanding. Therefore, we believe this is a long-term build, not a short-term trade. The fundamentals are far too strong to call it a trap, but the external pressures and the current valuation are too high to expect a quick recovery. This is an investment that is going to require patience. And that brings the final decision right back to you, the investor. We've laid out the blueprints, the structure is sound, but the external environment is uncertain, and the neighborhood is in need of some serious revitalization. So the ultimate question you have to ask yourself is a personal one. Do you have the patience to wait for the rebuild? Your answer is going to depend entirely on your own investment timeframe and your tolerance for weathering the storm until the market finally recognizes the value that's been built here. That's all for this deep dive from Iron Financial. We'll see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.